Well, good day and welcome back to ACG's series on personal financial planning with this week's topic, Investment Planning and Understanding Risk, Part 2 of 5. My name is Matthew Coyle. I'm the head CFP here at Advanced Capital Group, and thanks for joining us, and let's get started. Well, today we continue with our series, and today's topic of what is investment planning. As a reminder, we've talked about setting investment goals, today's topic of understanding risk, investment types, designing and managing investment portfolios, and of course taxes, other principles, and next steps. So let's start with today's topic, Understanding Risk, Part 2. Thanks again for stopping by. Well, let's start off this topic, understanding your investment personality. We all have a certain investment personality when it comes to understanding risk and how much risk we like to take. Few terms in personal finance are as important or as thrown around as often as the word risk. Nevertheless, few terms are as imprecisely defined. Generally, when financial advisors or the media talk about investments and their risk, the focus is on the historical price volatility of the asset or the investment that's under consideration. Prior to exploring risk in a more formal term, a few observations are worthwhile. First off, on a practical level, we can say that risk is the chance that your investment will provide lower returns than the expected return, or even a loss completely of your entire investment. You probably are also concerned about the chance of not meeting your investment goals. After all, you are investing now, so you can do something with this money at a later date. And whether this money is for college or for retirement, every investment carries some degree of risk, including the possible loss of principal, and there can be no guarantee at all that any investment strategy will be successful. So that's why it makes sense to understand the kinds of risk as well as the extent of risk that you choose to take, and to learn about ways to manage it. What you probably already know about risk, even though you might have never thought about it in the subject, is that you're probably already familiar with many kinds of risk from the life experiences that you've had. For example, it makes sense that a scandal or a lawsuit that involves a particular company may likely cause a drop in a price that will affect the company's stock, at least temporarily, and that can affect your perception of risk. In contrast, an overall economic slowdown or stock market decline might hurt most companies and their stock prices, with the exception of that one company. So there are many ways to look at risk from a standpoint of specific to industry level. However, there are many different types of risk to be aware of. Volatility is a good place to begin as we examine the elements of risk in more detail. As you're likely aware, investing involves risk, and intra-year risk, or risk within the current year, that volatility may skew our perception of long-term volatility if we only look at the short term. This chart shows that despite average intra-year index drops of 13.8% since 1980 for the S&P 500 index, and as a reminder, those are the 500 largest publicly traded companies in the S&P 500 index, 29 of the last 38 years have ended in positive territory. These swings throughout the year are very common. As such, long-term investors should be patient and look for long-term results, not short-term gains. If you're uncomfortable with going it alone, investors may consider working with an investment professional, such as an investment advisor or a certified financial planner or portfolio manager, to determine the risk tolerance and whether it's right for them. The duration of your investment horizon plays into this, along with other factors that may help you decide on the appropriate level of risk and the appropriate investment strategy that you wish to use. So now that we've introduced the topic, let's explore the different types of risk that can cause your account to fluctuate in value. A few of the many different types of risk are as follows. Number one, market risk. This refers to the possibility that an investment will lose value because of a general decline in the financial markets due to one or more economic, political, or other factors. This is the most common risk that you'll experience and which is most commonly felt by most investors. When you see a market go up, down, or sideways, you're referring to this as market risk. The next is inflation risk, sometimes known as purchasing power risk. This refers to the possibility that prices will rise in the economy as a whole. Thus, your ability to purchase goods and services will decline if you experience this risk, assuming no other changes. For instance, if your investment yields a 6% rate of return, but if the inflation rate rises to double digits, the invested dollars that you receive back will purchase fewer and fewer goods and services than they would the day before. Inflation risk is often overlooked by fixed income investors who shun the volatility of the stock market and completely ignore other types of risk which may affect their fixed income investments. When investing in conservative investments like bonds of all kinds, the most pertinent risk you'll likely face is inflation risk. The second type of risk we'll look at is interest rate risk. This, in addition to inflation risk, is felt widely by fixed income or bond investors and relates to the increases or decreases in prevailing interest rates and the resulting price fluctuations of an investment as a result, particularly bonds. There is an inverse relationship between bond prices and interest rates. As interest rates rise, the price of bonds tend to fall. As interest rates fall, bond prices tend to rise. If you need to sell your bond before it matures and your principal is returned, you do run the risk of loss of principal if interest rates are higher than when you purchased the bond. Another type of risk is reinvestment rate risk. This refers to the possibility that funds might have to be reinvested at a lower rate of return than is generally offered by the market. For example, a 5-year, 3.5% bond might mature at a time when an equivalent new bond pays just 2.5 or 3%. Such differences can in turn affect the yield of a bond fund or other investment. Another type of risk is default risk, otherwise known as credit risk. This refers to the risk that a bond issuer will not be able to pay its bondholders interest or repay principal when it is owed. This is quite commonly seen in the world of corporate bonds and less so in government bonds. Another type of risk is liquidity risk. This refers to how easily your investments can be converted to cash. Occasionally, the foregoing definition is modified to mean how easily your investments can be converted to cash without significant loss of principal. And of course, we're all familiar with political risk. This refers to the possibility that new legislation or changes in foreign governments will adversely affect companies you invest in or the financial markets they oversee. And of course, finally, currency risk. For those of you making international investments in currencies directly or purchasing investments that are denominated in other currencies, this refers to the possibility that the fluctuating rates of exchange between US and foreign currencies will negatively affect the value of your foreign investments as measured in US dollars. All of these risks will cause market volatility. Some are very short term and a few are longer term, of course, when it comes to your investments. Well, thank you today for stopping by. This, of course, was a very brief look at risk. If you have questions about these particular topics, please feel free to reach out to us. You can see my name and email on the screen there. Again, my name is Matthew Coyle. I'm the Head Certified Financial Planner here at ACG. And I'd like to thank you again for stopping in to take a look at the material and have a very, very nice day. And again, please reach out to us if you have questions on your account or the material involved. Thanks.